the case of small business entities, you're definitely best off taking advantage of the temporary full expensing rules. So you can see here the URL where I found this information, and you can dig through this and read into it. But then there's also this document here which you can find as an extension of that page I was on, and this really is a good document because it'll help you understand how to take advantage of the temporary full expensing rules based on what size entity you are. So it's got some good little graphics and charts here. And you can see here in the case of a small business with less than 10 million, you did have all these other options previously with instant asset write-off and backing business investment. With all these different dates, really got quite complex. But for any assets held from 6th of October, if you're a small business entity and you're using the simplified depreciation rules, yes, you can't opt out, but this is fine. What you're essentially doing is you're taking advantage of the temporary full expensing, and you're simply writing off whatever assets you have. And by virtue of the fact that you can see down here that only large businesses can't take advantage of this for second-hand assets, you can see you're actually taking advantage of this for second-hand assets as well. And probably the one asset class you want to be a little bit careful with is cars or motor vehicles, because if that is a passenger vehicle, you can't depreciate the whole thing. So just be aware of that with regards to cars, but otherwise it's super easy to work with. And essentially this is what you'll be doing. In the case of your financials, what you'll have is you will essentially write off the full value of your temporary full expensing. I always create a line item with that name, temporary full expensing. So let's just say that that was a particular asset. In this case, I've actually put the asset in here. So I've created an asset group. I've created an asset group which is temporary full expensing. So this is how I created that temporary full expensing asset group. And then I just put the grinder in there. So in this case, it's a grinder that we've bought on the 1st of the 1st, 2022. 100% taxable use. And if I then, I'll clean this up a little bit so you don't have to see my URL, but we've now got that asset in there. We've got it represented in the financials. And if you want, you can also do this. You can also put the asset full value, and you could just, if you wanted to have a whole lot of assets in this one group, you could. So assets temporary full expensing at cost. And then this is the sort of less than. So the accumulated depreciation on those temporary fully expensed assets, noting that the liability is exactly the same as the asset. That means there's essentially no asset balance left, and I can prove that to you by coming in here. We have a look in our financials inside of Logit. Have a look down here, and we've got temporary full expensing, the cost, and the accumulated. Reason for doing this is that at least you keep track of your assets as you buy them into the system. And if a bank wants to look at the balance sheet, they're going to see the full cost base of the assets. So it's quite a useful way to sort of represent things. Yes, you're not doing plant and equipment less accumulated depreciation, and you're not doing accounting-based depreciation for accounting, tax-based depreciation for tax. You're simply reusing the tax method across both the accounting and the tax. But look, if you're a small business entity, you're trying to keep costs down and keep things simple, this is a good way to do it. So you can see, because I've classified my temporary full expensing, so there's my temporary full expensing, classified to temporary full expensing. If I wanted to, for working paper purposes, I could link that to the cost base, which is on the balance sheet. If you wanted to use our working papers, that could be useful. But if we go back to that tax form and jump in there, so you can see how I've dealt with that, temporary full expensing. And then what happens is that temporary full expensing value comes back in from the tax calculator. So this value here is getting injected from the depreciation report, essentially. So from that depreciation there, it's coming back into the tax form. It's coming back in there, and then it's going into the reconciliation section. So you can see the non-deductible expense here is the accounting value of the temporary full expensing. And note that if you're using the small business entity and immediate write-off, it works differently. So just beware of that. You'd have to take into account if you are going to use the small business entity rules with regard to the small business pool or immediate write-off, it's handled differently to temporary full expensing. With temporary full expensing, it is added back as a non-deductible expense here. So temporary full expensing, added back as non-deductible, and then the tax value, which obviously is one and the same value, is extracted and taken off. So less the deduction for the decline in the value of those depreciating assets. And obviously the depreciation facts are automatically entered in here correctly as well. So really that temporary full expensing method is probably the best method that you can use if you're a small business entity through to 30 June 2023 by the looks of things. If in doubt, contact a tax agent. But this is definitely, in my opinion, a nice simple way to go.